Welcome to Building Wealthy Habits podcast. Now, this features content and conversations with me, Randy Barkley, Jeremiah Lee, along with Laura Lee. On this podcast, we share financial advice from a team of certified financial planners, including a California licensed attorney, an MBA professional with collective experience of over 40 years.
On this week's episode, Randy and I play a trivia game on taxes, and Laura is our gracious host. We try to make some fun with taxes. Everyone has to pay taxes. This episode is for someone who is considering how they can better improve their taxes going forward. We end the episode talking about the various, a couple of strategies that we use when we help our clients have long-term tax planning.
Hello, everyone, and welcome back to Building Wealthy Habits. So we have been in the midst of a 4-part series where we took a look back at some aspects of our industry to inform where we are currently, and in some cases talked a little bit about where we're headed. So we've done an episode now on the industry of financial planning, on inflation, investment, and the last of this 4-part series is on taxation.
Oh, taxes.
But for today, we got to cue up the content by the famous quote, "The only things in life that are guaranteed are death and
taxes."
We are. So I promised our listeners last week that I would do my best to make this content as entertaining as possible. So, drum roll, please. To kick off this episode, we are going to have a little game show. So we're going to...
Okay, so we got my buzzer.
Perfect.
Hey,
Let's show...
Sneeze.
Excellent.
And they sound like...
For those who are watching us over video, you can see the actual buzzers. For those who are just listening, this is the sound you need to listen for. Thanks for testing it. And we are going to call our little game show Tax Dash.
Tax Dash.
Tax Dash.
All right.
Okay. All right.
So thank you for...
Do we have to answer the question as a question?
Well, yeah, exactly. Just like Jeopardy. Does that make me Pat Sajak? Anyways, okay.
Yeah, kind of.
Wait, Alex Trebek.
I was going to say, wait a minute. It's not, that's...
Pat Sajak's Wheel of Fortune. Alex Trebek is Jeopardy.
Well, Alex passed away, so it's now Ken Jennings, I think. Yeah.
That's one of the quiz questions. I'll add that in. I'll let you know how you do on that.
How would I know that? Because I've seen it.
All right. So for this game, Randy and Jeremiah are going head to head to see who can gain the most points. You know what? One thing though,
beauty and the brain.
I'll let everyone determine which one is which. I have not yet determined a prize for our winner though of this game show. So
we get a cookie.
Any ideas?
Get a cookie.
Riverside
I like that.
Cookie Shop.
Earlier I was saying we get a day off, but I'm not sure if that's going to happen.
Oh, no, we need you around here.
That's right.
But that's a great plug. If anybody does actually come visit us here in our office, if they're local to Riverside, we give all of our guests fresh cookies made by a local partner of ours, Riverside Cookie Shop. In fact, they're right here within our block.
Yep.
And so they are fantastic.
And it's in some of a new thing. So if you haven't got your cookie yet, it's not because we didn't like you. It's just you haven't been in recently. So come on in.
Good point. It's a new thing. And you can have it while you're here. You can take it to go with you. So, but we try to sweeten the deal.
Yep.
All right, contestants. The trick is I will read the question, not until I'm done with the question, then you can buzz. First buzzer that I hear is the first one that gets to answer. If you do not get the answer correct, the second person has a chance to answer to gain the point.
All right.
All right.
If the winner is really the winner, I mean, that just means we know the most about taxes. Is that?
Hey, in our world, that definitely makes you the winner.
Win. All right.
All right.
All right. Randy, are you ready?
I'm ready.
Jeremiah, are you ready?
Ready.
All right. Hold up your buzzers. Ready? Question number 1. What is the largest source of tax revenue in the U.S.?
I'm going to go
Jeremiah. What
with income tax.
Individual income tax. I need like a ding, 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 ding,
That's right. And with your buzzer bell, yeah.
I was waiting for him to answer. I knew the answer.
Well, I was willing to be wrong because I thought I could go a lot of directions here.
So people know there's different types of tax. We have an estate tax, we have corporate tax, but individual income tax is the largest source of tax revenue in the United States. All right. Thank you. 1 point for Jeremiah. I better write these down because I might forget. Okay. 1 point for Jeremiah. Okay. Question number 2. The Tax Cuts and Jobs Act of 2017 reduced corporate tax from 35% to what? Randy.
20%. 20%.
Very close. Jeremiah, you want to try?
That's what I thought too. We're going to go 22%.
Oh, you're close too. Neither one of you gets a point. It is 21%.
Oh, no.
We were that close to it? Oh.
Maybe if I was feeling nice, I'd give you each a half a point, but then it just is the same.
No.
All right, 0 points on that. But yes, you're in the ballpark. So Tax Cuts and Jobs Act went from 35 to 21% for corporate tax. All right, are we ready?
Yep.
This is fun. Okay, question 3. It's always fun to ask the questions. You guys are really good at sports.
Mm-hmm.
All right. This one's going to take a little bit of explanation. What is the difference between statutory and effective tax rates? Jeremiah.
No, all right. So statutory is the number that it says, from $0 to $12,000, you have this rate. From $12,000 to $100,000, you have this rate. Whereas the effective tax rate is when you actually take all of what you're actually paying together. So you may be in the statutory or marginal tax rate of 24% or 25%, but really when you look at all your taxes, maybe you only paid like 22% as your effective tax rate.
So the statutory, by definition, is what most people would refer to as marginal tax rate.
Mm-hmm.
So that would be the last dollars earned has the highest tax rate. Yeah. I don't want to be left out of the answer.
I love that. You should get a bonus point for that. Right.
Oh, bonus
Statutory
points.
or marginal tax rates are the rates set by law and are often cited, but the effective tax rate is the actual percentage of income paid in taxes. And that can actually vary significantly depending on what the individual circumstance, deductions,
Right.
credits. That's why you come talk to your financial advisor about how to improve your tax situation. So
Yep.
there you go.
Good.
Thank you for the participation from both, although I have to give Jeremiah the point on that one. I'm really sorry.
He rang first. He's just a quicker buzzer.
Did everybody exercise their fingers and
Yeah,
thumbs?
that's right.
Okay. All right. Question number 4. It's still anybody's game, though, just so you know. Okay. What was the highest tax bracket in U.S. history? Randy.
95%.
I'm going to give that one to you, actually. It's 94, technically, what I looked up.
Come on.
I think you're so close. So this I thought was so interesting. The highest tax, that was amazing, by the way. Way to go. I didn't know that until I looked it up. Okay, Randy gets a point.
Is there bonus
highest-
points for like what year that was? That'd be a good bonus point.
Oh, that's true.
Is it-
Do you know
was it
what
post-
time period?
Post World War II? When do you remember that?
1943.
44 and 45.
Way to go. You are
close.
so close. That's great.
Yep. And it was during World War II.
Got it.
Marginal income tax rate reached 94%. This extremely high rate was implemented as part of the effort to finance the war. It only applied to income over $200,000. So at that time, that would be the equivalent to several million dollars in today's currency after adjusting for inflation. So it's a comparison.
So additional historical point. Can I give you a historical point?
Yes, please.
Ronald Reagan, when he ran for presidency, he talked about how the impact of having that high tax rate, it causes people to be not productive. So when he was in film, he said, I would never take any more income than $200,000 a year, because he said anything above $200,000, they were going to take 95% of it. He said, why would I work beyond $200,000?
Mm-hmm.
And so he was the first president that really dramatically it decreased the tax rate.
Interesting.
That's great.
Yeah.
That's a great point. I love that.
I like that little bit of history. Okay,
Point
are we
and
ready?
a bonus. I love it.
A point and a bonus. Okay. Question number 5. Similar to question number 4. But what was the lowest tax bracket in U.S. history? Randy.
0.
No. Although, I don't know. That was kind of an interesting answer. Jeremiah, do you want to try to save it?
10%?
Yep. Ding, 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 ding.
10%.
I would have gone with 0 also, because I feel like the standard deduction wipes out people's taxes. But you're right. The first bracket is probably something, right?
Okay.
Right.
Is that what you're asking? Is what's the lowest bracket?
Well, that was the question. Did you want me to say it again? What was the lowest?
I thought you were talking about historically.
Yeah, what was the lowest tax bracket in U.S.
that's fine.
in U.S. history?
Well, I mean,
That would be 10%. I agree with that.
10%, which has actually been in place for various different eras and periods. And
They just put the different dollar amounts in there.
Yep.
Right.
Yep. So 10%. Okay, Jeremiah gets the point. We are 3-1. Dad, you still have hope.
I got a bonus though. I got a bonus on that
Are
one.
we going to give you a bonus?
it's not a point. It's just like a way to go. High five.
I
Yeah.
think he's changing the rules.
trying to.
I think. Okay, ready? Question number 6. What investment strategy does Tricord implement to help reduce taxes owed in a taxable investment account? Andy.
We want to deal with appreciation of stocks rather than capital gains that would occur within mutual funds.
Okay.
Ooh,
Well,
that's a good answer. We do that.
okay. If you were to coin
I know what she's looking. I mean, he's looking for you to like qualified dividends, capital gains. You get the preferable tax rates.
yes.
I like his answer. I think what you were looking for was tax loss harvesting.
Ding, 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 ding.
I think you should get it though, because if you get regular short-term gains, you're going to get your normal tax rate. Whereas what Randy was saying, if you do capital gains, it's usually 15% for most people, which is
Okay.
better.
So does that mean, Jeremiah, you're officially giving your point
No.
to Randy? I think
Yes, because I got the answer right because I was more complex in my answer.
His was a little bit more complex.
Maybe the answer is just that we do multiple things at Tricord to make sure that you're paying the appropriate level of taxes and not more than that.
That's true.
Yeah, because I mean, you could expand that answer into making sure they contribute to the retirement plans, whether it be IRAs or 401ks or set up defined benefit plans or profit sharing. I mean, you could just really go a long ways
There's
on
a lot.
this.
There's a lot that goes into that. All right.
That's
Yep.
I think
true.
you're in the point, even though your paper didn't line up with that answer. I think it's a good answer.
Just because you got the answer doesn't mean I'm wrong.
Think about the test giver here. You got to think about, got to play to the crowd. Okay, here we go. Ready? Last question, by the way. All right, this could tie the game, or we could have a clear winner. Ready? Who was the infamous Chicago gangster who was in prison due to tax evasion in 1931? Andy.
Al Capone.
Ding, 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 ding.
Bonus point for Alcatraz. Is there a bonus point that he was in Alcatraz for tax evasion?
All right, so gentlemen, technically, it's a tie.
Oh,
It's a tie.
But if we're gonna give Randy the bonus point for
Oh, don't. I don't want any favoritism.
we can call it a
Unfortunately-
tie so that clients know whatever advisor they're talking to, they'll be in good hands for taxes.
that is true. Okay, we're gonna call it a tie. Oh, okay. Let me tell you a little bit about Al Capone though, because I thought this was interesting. Capone was convicted. Now he had many other crimes that he was suspect of. However, the conviction came down to multiple counts of tax evasion in 1931, and he was sentenced to how many years in federal prison?
Not long. It was less than 20. It's probably like 7 to 14, something like that.
Yeah, 11 years in
Okay.
federal prison.
That wasn't too far off.
Despite his involvement in organized crime, it was his failure to pay income taxes that ultimately led to his downfall.
Now, here's another point, case in point.
Hmm.
What did he die of?
Oh, I know this one. Do you know?
No.
He died. My understanding is that he died of gout.
No, he died of syphilis.
Syphilis.
And there was a cure for it, but Al Capone had a absolute fear of needles, and he would not allow himself to be injected with penicillin. So ultimately, he died of syphilis.
Really?
Look it up.
It's
That's right.
fascinating.
So look these up.
Another bonus point.
For a bonus, for anyone who doesn't
What that does for me today, nothing.
Yeah.
But,
No.
at least it's a
Yeah.
little point of
For
history.
anyone who doesn't know Randy well, he is a walking encyclopedia of historical
true.
facts. And whenever we play, I'm not charades, but I don't know, whatever those games are, we have to guess the historical
Trivia.
facts, trivia games. It's always good to be on his team because he's going to pull out these dates and these years that it's fantastic. He has a great
True
memory.
statement, because you had a subscription. I don't know if you still do, to National Geographic, and we'd come home from elementary school and we'd we'd have some research topic that we'd have to write a paper for. And you had an uncanny knack for remembering not just that it was in a National Geographic, but what edition of National Geographic
Well, it took me a while to kind of find it, but I had an idea what the front of the cover was.
To us, it seems like you just dusted it off and pulled it right off the shelf. Here's your research paper on the Titanic, Laura. You're welcome. I mean, it was, I remember you did that for the Challenger disaster. I wrote several different topics. So
who was the name of the pilot? Okay, this is going to throw it back at you.
Nothing to do with taxes. I think we need to get back to the topic.
Who was the name of the pilot that flew a bombing mission to Japan before the end of World War II? You did it.
No, I did not.
You did this. I was going to say like Chuck Yeager or something because he's famous, but I don't actually know.
Jimmy Doolittle.
Oh, yeah.
Oh, yeah. Remember that?
Sure. She remembers. Sure.
I did a lot of research projects.
I'm pretty sure it was you that wrote the paper on that.
I think so. If not, one of our siblings, my siblings might
That's so funny.
Chime in. Okay, all right. Well, back to the topic at hand.
Yeah, this is a good way to make taxes fun. Thanks for the game, Laura.
You're welcome. Thanks for playing along, folks. That has been this episode of Tax Dash.
Tax Dash.
Don't stay tuned for the next version.
Yeah,
wait till
exactly.
next year. That's right.
But in the minutes that we have remaining, I do want to talk a little bit about some key strategies that we implement around tax. And so we have a few that we want to touch on. There's obviously multiple. Randy alluded to them earlier, but the first one that I want to kick us off with is that when we sit down and meet with clients, oftentimes they're either preparing their taxes or they've just received their tax return, and myriad of emotions they can bring to us. So in that moment, it's a good opportunity to sit down and start some planning. And the most successful planning that we have is a multi-year strategy. It's not just a one-off. And so we want to take a look at how we can minimize the tax liability and maximize the benefit over time. So multi-year approach.
And a comment of why we're different than, or how we're different than like a CPA or your tax preparers, we don't do each year's taxes. And I think there's many accountants or enrolled agents that we work alongside that they're kind of just looking at what happened and reporting it and then helping you file your taxes. There's some though that we've worked with that they're very proactive in saying, well, next year, what if you did this differently? And that's the part that if your CPA or your accountant doesn't do that, that's kind of the gap that we fill, is we come in and say, okay, not just for what you did last year, but looking forward, what can we do differently in your finances over the next 3, 4, 5, 10 years that are going to benefit you from a tax perspective? And some of that could be investing, some of that's charitable giving. I have a client right now we're working with that we're doing a small Roth conversion every year. And in doing that...
Yeah, and that's very strategic because you have to look at, the amount of income that would come out of a qualified account, an IRA, let's say, and into a Roth, and you don't want to cross over getting into those higher tax brackets. You want to stay under the radar, so to speak, to make it more tax efficient.
That's right. They're keeping their taxes somewhat neutral, but they're able to convert this, and that's going to benefit them later in life as well as their kids when they inherit this. So that's kind of the difference we have. We don't prep individual returns each year, but we look at that longer term, multi-year approach and kind of say, how can we be strategic in the long term?
But we like to be friendly with our CPA friends.
There's...
We have a local partner here that we work with on a regular basis. Oftentimes our clients, if they have a existing relationship with a CPA, we're happy to work with them. And in fact, on tax day, Jeremiah, what did you do for our local partner here in Riverside?
Yeah, we're laughing. I should have taken a picture of it so everyone saw it. I took basically a basket of goodies of cookies and chips and things that just said you made it. I knew they didn't quite make it yet. It was that last day, but give them some treats in the office. And I know that there's a busy season for them, and it is specifically a busy day. Last year, I think I dropped off maybe like 2 bottles of champagne for them just to say you made it. But if you have a tax advisor, April 15th, it's a hard day for them. So sending them some encouragement, or even April 16th, saying way to go, you made it. It means a lot of just understanding, having empathy for the hard work they put in to get so many people ready for tax season.
And the reason that you want a tax advisor, that you're dealing with a CPA or an enrolled agent, is because the tax laws change. So much of what's happened over historical references is that what was going on in the 60s or the 70s is different than what's going on today. And all through that period of time, there's been massive changes regarding taxation, not only from the federal level, but also the state And you need to have somebody who is constantly aware of those changes.
Yep.
And providing that information to us as well as to our clients.
Yep. We keep in close contact with them. So if we have an idea or a client has a question, we oftentimes call and just say, hey, here's what we're thinking. And we work through the situations together. But yeah, CPA is a high stress, but high demand sort of job. And so remember to thank your CPA this April. Okay. So one of the other things that we do, which Dad, you made it sound even more complex because you added on some additional. But what I wanted to talk about was tax loss harvesting. We've talked about this on some previous episodes. But essentially, I'm going to put it in simple terms, and then you can add the complexity to it. But within a taxable investment account, you have recognized gains and losses when you trigger a sale of a holding. So if it could be a stock holding, and if you've had gain, let's say you bought it for $15 and you sold it for $25, you're going to have a $10 gain. So that gain accumulates within the account, and at the end of the year, you have to recognize that capital gain on your tax, on your income. And so what we like to do is try to offset those gains with losses within the account. There's obviously a strategy to go about doing this so that even though the account continues to grow, you'd have a non or a very minimal taxable event at the end of the year.
Yeah, and our software, also are the people that we work with from an investment standpoint. We are all throughout the year, we're looking at what the gains and losses are. Not only the total, what I call the performance, not only the total return of the account, net of any costs and fees, but what's the taxable event? So obviously, if we can achieve a higher performance on a per year basis without taxes or very minimal taxes, that's a win-win situation for the clients.
That's great. Yeah, way to go.
So you touched on some other strategies that we put in place for taxes. Dad, you talked about that in terms of your answer. Did you want to touch on any of those? You talked about contributions to retirement accounts, et cetera.
Well, I think one of the biggest changes over the last couple of years is the advent of the donor advised fund. And for people who have wealth, their options were to set up a charitable foundation or to kind of hold off on appreciated assets and give those to a client, but now, or to a charity that they really strongly believe in. But now we can do donor advised funds, which is very interesting because you can put the money into it. You can put the capital appreciated assets into this donor advised fund. You get the write-off for the total, the market value of whatever you're putting into the donor advised fund, and you don't have to give that money right away. So you could bunch, you could put money, you could put a lot. If you had a high income in a particular year because you sold a business or whatever, you could put a large amount of money in this donor advised fund and then distribute the gifts to the various charities. And you don't even have to select a very specific charity at the moment. You can pick and choose as you go. And it's just a very flexible way to give. I mean, it's an amazing way to give right now.
Yep, it's great. We've had a number of business owners, as they sell their business, they have a very large taxable moment. They'll take their next 10 years or so worth of giving, compress it into that one taxable year, and put it in a donor advised fund. So they get the nice large write-off. It helps their taxes. But then over the next decade, they're able to kind of liberate those funds as appropriate as they go to events and they have charities that they appreciate. And it's been a really good way to maximize what exists in the tax code for clients.
And I love, just to touch on this point too, the legacy that it provides. So the donor advised fund moves outside of that individual's estate. And if they were to pass away, the donor advised fund continues. And so you can denote a beneficiary to continue to oversee those funds, but they are marked for charitable purposes. So they have to be given to federally recognized charitable entities. And so it essentially passes on that legacy of charitable giving. So I love that point. You'd alluded to this, Dad, a little bit, which is bunched giving. And that's another strategy for those high income moments, or if your income fluctuates year to year, or you're looking for a particular high deduction in that year, if you can get it, what you can do is you can bunch your giving. So, and there's some calculations to do around this. You want to make sure that it's beneficial. You have to take into consideration your standard deduction. But essentially you could give in 1 year what you would typically give in 2 years and take a greater tax deduction in year 1 and then take your standard deduction in year 2. And overall that can net lower tax liability over 2 years.
Correct.
Yep. And that's one where it takes some math to figure out if that's going to work or be useful for a client. We've had some where it just doesn't pencil out, others where it's very beneficial. But that's one of those discussion points to say, what do we want to do, not just in 1 year, but with a multi-year approach.
Yep. All right. Well, it's about time for us to wrap up this podcast. I want to thank our listeners. For anyone who listened to this entire episode on tax, kudos to you. We hope that it might have even put a little bit of a smile on your face. And so, as always, thank you for listening.
Until next week, folks, may you grow in wisdom and knowledge. Thank you for listening.
We have a few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review. Even if it's not 5 stars, we welcome the feedback.
And we invite you to let us know what topics you would like to hear more about or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit tricoreadvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, we'd be thrilled to see how financial planning can benefit your life. Email us at contact@tricoreadvisors.com or simply click on the link in the show notes.
This show was produced by Graham Gardner at Model FA. Find out more about how to create a podcast for your financial planning business by visiting modelfa.com. We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Tricord Advisors, we are your future's best ally.